Chesapeake Energy, CHK on Russell 2000 Index. Company analysis, liquidity ratios, and risk analysis ratios in dollars in millions by Dwayne Gray, June 3rd, 2024. Liquidity ratios are used to judge a company's ability to meet its short-term commitments. Quick ratios. Quick ratios equals current assets subtract inventories divided by current liabilities. In 2023, the quick ratio was 1.9855 to 1, or $1.99. In 2022, it was 0.6949 to 1, or 69 cents. In 2023, the ratio of $1.99 to 1 means that Chesapeake Energy has $1.99 into of current assets exclusive to inventories to meet $1 current liabilities. There is absolutely no standard for the quick ratio, but 1 to 1 or better suggests a good liquid position. Also in 2022, the rate was 70 cents for every dollar Chesapeake Energy that had a dollar of current liabilities. Not so well. Risk analyst ratios. How well a company deals with its debt obligation. Asset analyst ratios. 2023 to 2022. In 2023, total tangible assets subtract current liabilities subtract short-term debt divided by total debts outstanding or total liabilities equals 3.4012, or total debt in 2022. Total tangible total assets subtract current liabilities subtract short-term derivative debt divided by total debt outstanding equals total liabilities equals in 2022 equals 2.0183. Asset analyst ratios. The ratio of 3.4012 to 1 in 2023 and 2.0183 to 1 in 2022 means that Chesapeake Energy has, for example, $3,401 in NTA for each $1,000 of total debt outstanding in 2023, and $2,018 of NTA for each 1,000 of total debt outstanding in 2022. The asset value behind $1,000 of total debt outstanding is important information for debt holders. Normally, they have a claim against all companies' assets after providing them for liability items, which right ahead of the claim. To be conservative, goodwill and other intangible assets are first deducted from the total asset figure. In our example, Chesapeake Energy Limited $3,000, $3,401 in 2023 and 2,018 in 2022 of asset back for 1,000 of total debt outstanding after providing for current liabilities. Short-term borrowing and the current portion of long-term debt are excluded from current liabilities, but they are included in total debt outstanding. If the industry standard for ratio in the retail companies should be at least 2,000 of NTA for 1,000 total debt outstanding, this company meets, in fact exceeds the standard. Industry standards for this ratio vary due to part of the sustainability of income provided by this company. Usually, for example, are fairly stable and a great source of income, greater assurance of income continually compared to retail stores. They are characterized as heavy investment permanent properties, which account for a large part of their total assets. They are also subject to which ensures the utility a fair return on its investment. Debt to equity ratio. Total outstanding debt divided by equity equals short-term borrowing plus current portion of long-term debt plus long-term debt plus long-term derivative debt plus other long-term debt divided by total equity. In 2023 was 0.2521 to 1, or 25%. In 2022 was 0.3673 to 1, or 37%. The debt to equity ratio is often expressed as a percentage of debt to equity. In the example above, the total amount of debt represent represents of represents of the 2000 represents of 25% in 2023 and 30% 7% in 2022 size of total amount of equity size the total amount of equity. This ratio of 0.25 to 1 or 0.3676 to 1 is little below or low for Chesapeake Energy is acceptable and is not and does not exceed industry standards for retail stores. I do repeat, this is a little low for Chesapeake Energy, so the improvement is there's room for improvement. Cash flow to total debt outstanding ratio equals cash flow from outstanding operating activities divided by cash total outstanding debt equals operating income plus depreciation subtract share-based compensation, which is share to associates plus working capital, which is current ratio current assets divided by subtract current liabilities divided by short-term borrowing current portion plus current portion of long-term debt plus long-term debt plus long-term derivative debt plus other long-term debt in 2023 equals 1.9253. In 2022 was 18105. Cash flow to total debt outstanding ratio 1.93 in 2023, 1.81 in 2022 of total debt outstanding. Cash flow from operating activities is a measure of a company's ability to generate funds internally, other things being equal. A company with a large increase in cash flow is better able to finance expansions of its own funds without need for issuing new securities. The increased interest or dividend cost of new securities issue reduce cash flow and earnings, and issue of convertibles or warrants may dilute the value of the common stock. The cash flow to debt outstanding ratio gauges company's ability to repay the funds it has borrowed. Short-term borrowings must normally be repaid or rolled over within a year. Corporate debt issue commonly have sinking funds require annually cash outlay. A company's cash flow from operating activities should therefore be adequate to meet these counts. But for calculation, it is important. With this 1.93 2023 and 1.81 2022, it's almost uh double than what they have for debt. So they have some room to work with internally in their company.